You're about to watch something that could fundamentally change how you see the global silver market. Right now, at this exact moment, the London Bullion Market Association tells the world their vaults hold approximately 933 million ounces of silver. That's the official number. That's what they want you to believe. But here's what they're not telling you. Roughly 400 million ounces of that silver, that's 40%, might as well not exist. It's there, it's real metal sitting in vaults under London, but you can't buy it, you can't access it, and if there's ever a rush for physical delivery, it's not coming out. I'm talking about the biggest liquidity illusion in the precious metals market, a system so carefully constructed that even most professional traders don't understand how it actually works. This isn't a conspiracy theory pulled from some Reddit forum at 3 in the morning. This is publicly available data that nobody bothered to connect until now. The LBMA publishes vault totals every month. ETFs publish their holdings. Institutional investors file their positions. All of that information is right there, sitting in plain sight, and when you actually do the math, when you trace where that silver really is and who controls it, the entire narrative falls apart. So here's what we're going to do in the next 15 minutes. I'm going to show you exactly how this works, why the vaults being full doesn't mean what you think it means, and why this matters whether you own a single ounce of silver or you've never touched a precious metal in your life. Because when this breaks, and it will break, the ripple effects are going to hit markets you didn't even know were connected. Before we go any further, if you want to keep seeing investigations like this, content that actually questions the official story instead of just repeating press releases, hit that subscribe button right now. This channel exists because enough people decided they wanted uncomfortable truths instead of comfortable lies. That's the deal. Now let's break down exactly what's happening in London. The London Bullion Market Association is the heart of the global precious metals trade. When people talk about the gold price or the silver price, they're talking about prices set in London. The LBMA oversees the vault network where commercial banks and specialized vault operators store precious metals for clients all over the world. Every month, they publish a report showing total holdings. As of the most recent data, their vaults contain approximately 933 million ounces of silver. That sounds like a lot, because it is a lot. At current prices, we're talking about somewhere around $25 to $30 billion worth of silver just sitting in underground vaults in London. The LBMA points to these numbers as proof that the market is functioning perfectly, that there's plenty of metal to go around, that anyone worried about physical shortages is being paranoid. They even publish photographs sometimes, those glamour shots of massive silver bars stacked floor to ceiling in climate-controlled rooms, guarded by security systems that would make a casino jealous. The message is clear. Look how much silver we have. Everything is fine. Go back to trading your paper contracts and stop asking questions. But here's where it gets interesting. Let's talk about who actually owns that silver. The LBMA doesn't publish ownership breakdowns because that would be too transparent, but we can reconstruct a pretty accurate picture using other public data sources. The largest chunk by far is owned by exchange-traded funds. The iShares Silver Trust alone holds over 450 million ounces. The Aberdeen Standard Physical Silver Shares ETF holds another 160 million. Sprott Physical Silver Trust, another 140 million. Just those three funds account for roughly 750 million ounces. Most of that silver is stored in London LBMA vaults. When you buy shares in these ETFs, you're not buying silver you can take delivery of. You're buying a financial instrument that represents fractional ownership of a pool of silver held by a custodian. The prospectus for every single one of these funds makes it crystal clear that individual shareholders cannot redeem their shares for physical metal. Only authorized participants, which are large financial institutions, can execute redemptions in massive blocks measured in hundreds of thousands of ounces at minimum. For a retail investor, your shares are permanently locked into the fund structure unless you sell them on the secondary market. That silver is physically real. It absolutely exists in those vaults. But from a liquidity standpoint, it might as well be on the moon. Now let's add the second category, allocated institutional holdings. These are positions held by commercial banks, hedge funds, sovereign wealth funds, and private clients who store their metal in allocated form, meaning they own specific identified bars. Industry estimates suggest this accounts for another 100 to 150 million ounces in London vaults. Allocated metal belongs to the client, not the vault operator, and while technically the owner could request delivery, the practical and financial barriers to doing so are enormous. You need to arrange transportation, insurance, secure storage at the destination, assay verification, and in many cases, you trigger tax events or regulatory reporting requirements. For large institutional holders, the whole point of keeping metal in London is access to the LBMA trading system. If they pull their metal out, they lose that access. So this silver also tends to stay put, except under extraordinary circumstances. That brings us to the third category, and this is the one that matters. Unallocated metal and free float inventory. This is silver that's actually available for trading, leasing, and delivery to clients who need physical metal. This is the liquidity cushion that makes the market function. By process of elimination, if total London vaults hold 933 million ounces, and somewhere around 750 to 800 million of that is locked up in ETF and allocated positions, we're looking at maybe 130 to 180 million ounces of genuinely available silver. That's the working inventory of the entire London market. And here's the kicker. Even that number is probably overstated because it includes metal that's already committed to leases, forward contracts, and other obligations that make it unavailable for immediate delivery. Let me put this in terms that make the absurdity clear. Imagine a bank that has $10 million in its vault. They publish that number, they show you the cash sitting there, everything looks great. But then you find out that 9 million of those dollars belong to safety deposit box customers. That money isn't the bank's, it's not available for withdrawal by regular depositors. It's just being stored there. The bank only has $1 million of actual working capital. Now imagine that bank is taking deposits, making loans, and operating as if it has the full 10 million in reserves. That's fine, right up until there's a run on the bank. That's what we're looking at with London's silver vaults. The total holdings number that gets reported every month is technically accurate but functionally misleading. It creates the impression of deep liquidity when the reality is that available silver is a fraction of the headline number. Why does this matter? Because the entire paper silver market trades on the assumption that physical delivery is always available if someone actually wants it. The futures markets, the unallocated accounts, the forward contracts, all of these financial instruments derive their legitimacy from the belief that they're ultimately backed by accessible physical metal. If I sell you a futures contract for 5,000 ounces of silver, the reason you're willing to accept that contract is because you believe that if you stand for a delivery, you'll get your silver. But if the actual available inventory is only a small fraction of the total paper claims, then the entire structure is built on leverage that nobody's acknowledging. We've seen this movie before. December 2020, the silver market experienced a delivery crunch. Futures contracts were trading at significant premiums to spot prices because people actually wanted physical delivery, and there wasn't enough metal available in eligible warehouses to satisfy demand without disrupting the market. The exchanges quietly adjusted delivery rules, and somehow enough silver materialized, but the whole episode revealed just how thin the physical market actually is relative to paper trading volume. Let's talk about what happens when stress hits the system. Industrial users of silver don't care about ETF share prices or futures contracts. They need actual metal delivered to their facilities. Solar panel manufacturers, electronics companies, medical device makers, these industries consume roughly 500 million ounces of silver per year globally. A significant portion of that flows through London at some point in the supply chain. If the available free float inventory in London is really only 150 million ounces, that's less than 4 months of global industrial consumption. That's not a comfortable cushion. That's a razor-thin margin for error. And this is before we even consider what happens if investment demand surges and people start pulling silver out of the market. Here's an analogy that might help. Think about concert tickets. Ticketmaster might tell you that a venue holds 20,000 people, so there are 20,000 tickets available. But then you find out that 12,000 of those tickets were sold to season ticket holders years ago, 5,000 went to corporate sponsors who aren't selling them, 2,000 are held for the artist and VIP packages, and only 1,000 tickets are actually available for public sale. The venue still holds 20,000 people. That number is true, but if you're trying to buy tickets the day of the show, you're competing for a tiny fraction of the total capacity. The headline number and the accessible reality are completely different things. That's London Silver Vaults in a nutshell. Now let's talk about why the people running this system have every incentive to keep the illusion going. The London precious metals market is enormously profitable for the banks and institutions that operate it. They earn fees on storage, they earn spreads on trading, they earn interest on leasing metal to short sellers and industrial users, they earn management fees on ETF assets. The whole ecosystem works beautifully as long as everyone believes that physical delivery is available if needed, which means nobody actually tries to take delivery in size. The moment people start questioning whether the metal is really there and really accessible, the moment someone tries to call the bluff by demanding large-scale physical delivery, the entire fee-generating machine is at risk. So there's a very strong institutional bias toward publishing reassuring vault totals and avoiding any detailed breakdown that would reveal how much of that metal is actually locked up. This is where the comparison to 2008 becomes uncomfortably relevant. Before the financial crisis, everyone believed that mortgage-backed securities were safe because they were backed by real houses with real value. The AOA rating said so, the model said so, the bank said so. What people didn't understand was that the same house was often effectively backing multiple layers of derivative securities, and that the whole structure depended on housing prices never going down. When that assumption broke, the entire thing collapsed because the actual underlying collateral wasn't sufficient to support all the claims against it. We're looking at a structurally similar situation with silver. The physical metal is real, the vaults are real, but the claims against that metal through futures, unallocated accounts, ETF shares, leases, and forwards may far exceed what could actually be delivered if everyone tried to convert paper to physical simultaneously. And just like in 2008, the people running the system will tell you this scenario is impossible, right up until it happens. Let's run through some basic math that should terrify anyone paying attention. The global silver futures markets trade roughly 1 billion ounces of paper silver every single day. That's more than the entire annual mine production of silver in a single day's trading volume. The total open interest in COMEX silver futures alone is routinely above 500 million ounces. Meanwhile, the eligible inventory in COMEX warehouses fluctuates between 200 and 300 million ounces, much of which, like London, is tied up in ETF holdings and allocated positions. The ratio of paper claims to deliverable physical metal is conservatively somewhere between 5 to 1 and 10 to 1, depending on how you calculate it. The system functions smoothly, as long as that ratio stays theoretical. But if even 10% of paper holders decided they wanted physical delivery at the same time, there isn't enough accessible metal in the system to satisfy that demand without prices going vertical. You might be thinking, okay, but why would everyone suddenly want physical delivery? What would trigger that kind of rush? Let me give you a few scenarios. Scenario 1, a major geopolitical crisis that makes people lose faith in financial assets and rush to hard assets. We've seen hints of this with gold during periods of extreme uncertainty. Scenario 2, a significant industrial shortage where manufacturers are willing to pay massive premiums for physical metal because they literally cannot operate without it. This has already happened in smaller metals markets like palladium. Scenario 3, a loss of confidence in the LBMA or COMEX system itself, triggered by a failed delivery, a scandal, leaked documents showing the real inventory situation, or regulatory investigation. Once people believe the metal might not actually be there when they need it, the scramble becomes self-fulfilling. And here's what makes the 40% empty thesis even more concerning. The people who would panic first aren't retail investors. It's the sophisticated institutional players who understand exactly how the system works. They're the ones with the access and the capital to execute large-scale redemptions and deliveries. If they smell trouble, they move first. And by the time retail investors figure out what's happening, the accessible metal is already gone. This is what happened with bank runs throughout history. The people who got their money out were the ones who acted on the first hint of trouble, not the ones who waited for official confirmation that something was wrong. The LBMA will tell you that they have protocols in place to handle delivery requests, that the market has functioned for decades without failing, that concerns about physical availability are overblown, and they're right that the market hasn't failed yet, but that's not the same thing as saying it can't fail. Every financial crisis in history was preceded by authorities insisting that the system was sound. Every market failure was impossible, right up until it wasn't. The question isn't whether the London vaults physically contain 933 million ounces of silver. They probably do. The question is, how much of that silver is actually available if people want it? And the answer based on publicly available data appears to be less than half. What does this mean for prices if this becomes widely understood? If the market starts pricing silver based on available inventory rather than total vault holdings, you're looking at a fundamental revaluation. Scarcity drives price, and if the true float of available silver is a fraction of what people believe, the current price doesn't reflect that scarcity. This is separate from any discussion of market manipulation or price suppression. This is just basic supply and demand with accurate information about what's actually available to trade. And for industrial users, this represents a serious supply chain risk. IF, you're building a factory that depends on steady silver supplies, and the spot market seizes up because available inventory disappeared. Your entire business is suddenly at the mercy of whatever metal you can source at whatever price someone demands. For retail investors, this is a question of whether you're holding real exposure or just paper promises. If you own Silver ETF shares, understand that you're holding a financial claim on metal you cannot access directly. That's fine in normal markets, but potentially problematic in a crisis. If you own physical metal in your possession or in allocated storage where you have clear title to specific bars, you're in a completely different position. The people who understand this distinction are the ones who won't be caught off guard when the music stops. So where does this leave us? The LBMA vaults hold a lot of silver. That part is true. But the idea that this silver represents deep liquid markets where physical metal is readily available to anyone who wants it is a carefully maintained fiction. The reality is that roughly 40% of London's reported silver holdings might as well be in Fort Knox for all the good they do in terms of market liquidity. This isn't a smoking gun. It's not a conspiracy. It's just the logical conclusion when you actually look at who owns what and what they can do with it. The system works fine as long as nobody asks too many questions and nobody tries to take too much metal at once. But that's not stability. That's just a fragile equilibrium waiting for the wrong shock. The uncomfortable truth is that we live in a financial system built on confidence and leverage, where the lines between what's real and what's paper have been deliberately blurred. The silver market is just one example of a much broader phenomenon where headline numbers don't match underlying reality, where the people running the system profit from complexity and opacity, and where, by the time the problems become obvious, it's too late to protect yourself. You can choose to believe the official story, that everything is fine and these vaults are proof that the silver market is healthy and functional, or you can look at the actual data, do the math, and recognize that we're one crisis away from discovering just how empty those vaults really are when it counts. If this investigation made you question things you thought you understood about how markets work, hit that subscribe button and turn on notifications, because this is what we do here. We find the uncomfortable questions nobody else is asking, and we follow the data wherever it leads. Drop a comment and let me know what you think. Am I crazy, or is this the biggest liquidity illusion in precious metals? And if you want to go deeper, check out the description for links to all the public data sources I referenced. Everything I showed you today is verifiable because it's all sitting there in plain sight. Most people just never bothered to connect the dots. Now you have. The question is what you do with that information. Thank you for watching.